All right, we're live now. Okay, cool. Excellent. Well, hello, everybody. I'm glad to see we have quite a bit of people in the audience. Thank you very much for coming over from the OGC stream. I have with me today. Oh, what the fuck? Oh, damn it. I got my fucking. Oh, God. I'm hearing myself in the fucking thing. I forgot to.
Technical difficulties.
I hate when that happens, actually. I hate when
Yeah.
you like, because you have the headphones in, right? And then you have the YouTube tab up on your
Yep.
own channel and you have the stream, and then you press the go live button, and then it takes like an extra 2 seconds before and you're getting bombarded with your own voice, and I hate my own voice. So, anyway, but with all that said, we have a very special guest today. We have Mr. Sean Wieland, who is a real person. This is not a holographic display that you are seeing in front of you. And we have you on to discuss the wonderful and serious topic of managerialism.
Yes, thank you. Yeah, glad to be here. Thanks for putting up with. I had some family issues earlier in the week that we had to reschedule, so I appreciate everybody who's tuning in now and the loyalty of that, and especially being on the back of that episode of Pony Express as well.
Yeah, no problem. It's always good to have new friends on the channel. My channel, like, I feel like my own content creation gets really now that I'm on the OGC, I put out a lot of content for them, and I appear on a lot of other people's channels and other places. But like, my own channel and my own Substack seems to be growing cobwebs, and I can't say that I really enjoy it. But thank you for coming on. It's a pleasure to have you on. So
yeah, happy to be here. So yeah, I mean, we were discussing before this started. Did you have a specific entry point you wanted to get into, or I could just kind of give an overview of the direction my book is headed in, or how do you
why
want
why don't we start with your book, actually? So you wrote a book on managerialism, or this related topic, economic affairs, and this is kind of like where a lot of people in our spheres, especially in A sphere, got into their red pill journey and kind of got onto the pathway they're on is through economics, and especially Austrian economics of a more libertarian type, of the Austrian school being the economic school that the Ludwig von Mises Institute espouses most deeply. That's the economic school that is associated with that institution. So realistically, that overlaps with why we're all here, because we don't like managerialism. And the reason why we initially figured out that we didn't like it was because we were all talking libertarian talking points about how we didn't like taxes, or we wanted less, federal bureaucracy in our face every single day. But of course, it goes a lot deeper than that. So can you explain to us what your book is about?
Yeah, I mean, it covers a lot, but I would say, beginning with the core thesis that so there's those well-tread categories of income tax and central banking, and how it's basically a managed economy and all of the problems with that. But the part that kind of sneaks through that doesn't get as much recognition is the rise of the corporation, especially publicly traded stock. So that's really, in my view, how the Managerial Revolution was funded. You look at the origin of this with the War of Secession was kind of the trial run. A big reason why the Union was successful in defeating the Confederacy is because they were funded by selling sovereign bonds to Europe, whereas the Confederacy just did straight naked inflation. So, hence like Confederate money being kind of that, meme or joke. But then the more production version of that same phenomenon was the issuing sovereign bonds for the First World War. And that act that created treasuries is the one that persists to this day. Every time there's a debt ceiling crisis regarding, we got to raise a debt ceiling that's authorized by Congress, and why is it set up this way? And that law to create treasuries originated from how the First World War is going to be funded. Woodrow Wilson and all of that was really in order to, plunge America into a war in order to have the justification to impose a centrally planned or managerial economy. Getting individual people, the retail market was essentially created through issuing those original Liberty bonds, That's what got people used to the idea of regular people of owning securities. I mean, there had been stocks available before then for basically for railroads and for telegraph companies. But the idea of normal people buying securities like that really didn't become a thing until it was a manufactured market, really, due to the First World War, which quickly led to, in the 1920s, of course, the stock market bubble, and then 1929, the stock market crash. And the other component of that, too, is because of the inflationary pressure of the First World War, it was the first time that people noticed that they had to do something with their money in order to get ahead of losing their purchasing power due to inflation. Before then, what most people had experienced is basically you just have to put your money in the bank. You don't have to be an investor if you're a saver, both because of the deflation from increasing efficiency from capital in the Industrial Revolution, as well as getting a decent interest rate from the bank. So between those two, you were netting, I recall correctly, about like, say, 7 or 8%. So, all you had to do was be a saver and you were coming ahead. It wasn't until after that that now people felt like they had to do something in order to even maintain their purchasing power.
Yeah, and there's an interesting discussion, especially with people who talk about the Federal Reserve and all of that stuff in Austrian economics, of the legacy of my favorite president, actually, who's Calvin Coolidge. In that whole post-war period, there's a lot of, or at least there's some doubt now that Calvin Coolidge's economic record was as good as advertised, if that's the case, right? Because everybody loves to tout, he had 5%, 4% economic growth, and during the booming 20s, right, the roaring 20s or whatever it's called, right before the Great Depression. And so that's a very interesting theory. But really, I think there's also some interesting overlap with Austrian econ here, right? This is where the Austrian autism kicks in, because where do you put your money before all of these sorts of securities and like government bonds and et cetera, and all of these other little like debt creation schemes happen in the 20th century? Like, where do most people put their money? Well, Ludwig von Mises would have said, well, you put your money or your value into real money, right? For him, there's really no separation between money and a physical commodity, that is to say, gold. So that's a very 19th century perspective. But I think with what you're seeing now, and of course, gold is incredibly valuable now, and it's increasing in value exponentially over the past couple of years. I think it just went over 2,000. And of course, Bitcoin, as also an alternative escape to precious metals, is also another alternative. And so that's obviously, that went up and then it went down and then it's up again to 40K this last week. So really, all of these different alternatives seem like it's never just one alternative, right? Because if you're like, okay, everyone's going to start fleeing to real assets once you make a scheme or some kind of inflationary monetary
like an asset
policy.
bubble.
Yeah, or an asset bubble or an inflationary monetary policy. People always flee to real goods. So once they flee to real goods, if you're FDR, you're like, okay, the only real good in the market, or if you're a communist, of course, as we went over in Stalin's war, the only real good is precious metals and especially gold. So once you have just that, then it becomes very easy to target the one area that people can go to store their wealth. Well, now there's multiple ways to do that. So I think that's why the managerial regime finds Bitcoin so problematic.
Okay. So all of these questions start to circle the kind of economist wanking topic of what is money. Whether the natural default is commodity money, I think, is a question that is still under debate. Especially kind of getting the Austrian school, and where I think they're missing a step is soft money is almost inevitable. The reason a banking regime emerged, even in free banking or private banking, is there's letters of credit dependent on demand or redemption. So no matter how hard of a currency you try to impose, whether it's gold bars or Bitcoin or what have you, if you're operating a business, for example, you're going to have accounts receivable that, even if it's like a net 30 or a net 60 or net 90 payment plan, you're now creating credit in the market. Hey, I'll pay you next week, or I'll settle up at the end of the month. Well, every time everybody does that is some form of credit creation. Granted, the Austrian critique of allowing the government to, or the administrative state or managerial state, to kind of extend that indefinitely through centralized banking is the real crux of the issue. But I think that the hard money versus soft money debate is, how do I want to put this, a bit of a distraction, in the same way that the debate among the Austrian crowd between public and private is a distraction. So going back to my book, I would argue that large publicly traded companies are operating in exactly the same way as government administrations operate. They're managed in the same way. They're trained to think the same way. They work in lockstep in the same way. And obviously, there's that intermeshing between the regulations of publicly traded securities, like shares of publicly traded stock, and then also being able to do share buybacks or get loans of credit from a central banking system, which is also, so that symbiosis is there. And in reality, whether you say it's public or it's private in the modern context is more a way to get around the supposed rule of law restrictions. It's kind of like a story that everybody tells himself. When the 2008 crisis happened, they created a special purpose vehicle for mortgage-backed securities, because unlike the Bank of Japan, the Federal Reserve is not supposed to be able to buy these publicly traded securities. Early on, that the idea when the charter was made for the Federal Reserve was they were trying to make that a firewall, kind of similar to how Glass-Steagall was meant to be this firewall. But of course, they find a way to work around it. So all they do is they say, well, we're going to create a special purpose vehicle called Maiden Lane. The government's allowed to create and own that. And then they have a charter to then be able and buy up those mortgage-backed securities. So very much kind of like Chevron doctrine, that if Congress can't do it explicitly, well, then they're just going to create an agency to do it on their behalf, and that you get that same administrative or fascist structure to work in a modern way regardless. It's just kind of like, how do you have to craft the narrative in order for everybody to go along with it?
Yeah, and this is, I actually, I have something to say just right here. So this is where, because you mentioned the housing crisis, this is basically the exact structure of Fannie Mae and Freddie Mac, right? Mm-hmm. Those are, originally, they were a government institution, a government corporation that later, quote unquote, became private institutions, at least in the case of some of these institutions. But really, they were doing the same job as power wanted them to do all along, regardless of whether they were directly working underneath the umbrella of the federal government or whether they were a private corporation who has like a special exemption. And basically, they're a state-backed corporation, basically. And the great criticism that the Austrians had was that, oh, well, these are obviously state-backed corporations. I don't care whether you say that they're technically private. They're doing exactly what power always wanted them and intended them to do, mm-hmm. which is to provide mortgages to low-income people, to provide housing using financial mechanisms that are, kind of outside the market process for people who are inside of a political coalition.
Right. To implement public policy, right? I mean, that's the quintessential managerial role, is that government is going to have some, public policy decision. Usually the universities are manufacturing that public policy. And then you have the journalists who create the propaganda to get everybody to go along with it and accept it as, oh, yeah, this is how things should be, to manufacture consent or manufacture public opinion. But that's exactly, that's kind of the telltale sign, is that these are not emergent cultural phenomena. This is, a managerial decision to try to craft how they want the economy to operate. And that's really the consequence of those two world wars, is that's what they were fought to implement. And as a result of who won, that's the system that was designed afterwards. And, the thing we're realizing now is that so we've entered this period of stagnation, just like after the Soviet Revolution in the USSR, that managerialism is so inefficient that eventually you reach this point where the system is broken, but the people who are in power as a result of that system are very comfortable, and they're not going to give that up. They'd rather be king of the ashes, and there's no capacity for innovation. They're very much like Peter Thiel or Tyler Cohen. They have the Great Stagnation Thesis, or even the Nick Land and who's the other one, Fisher. The idea of the slow cancellation of the future.
Was that Bobby Fischer? Are you talking about Bobby
No,
Fischer?
No. From Zero Books. I could Google it. I'm sure the commenters are talking about it now.
Fisher King?
No, give me a moment. I'll actually look it up then.
Yeah, no worries. Yeah, so this is where Mark Fisher. Okay. Yeah, I mean, this is for our audience who's very into, or at least has exited libertarianism and now exited NRX land, which is basically kind of an outgrowth of libertarian anti-managerial practice. I think that James Burnham is probably somebody that we should bring up at this point, because Burnham's thesis essentially is look, the managerial revolution in the 30s basically happened, and there's really not a whole lot of distinction between fascist Italy and Nazi Germany as the Axis bloc, the United States and the UK, or Great Britain at the time, for Oceania bloc, and then you've got Eurasia in the form of Soviet Russia and Maoist China, right? So the problem is that realistically, at least I think this is the most fascinating thing, right? Is that all of these systems eventually are now collapsing under their own weight. I think that the historical question would have been what would have happened if a Nazi Germany or a fascist Italy had persisted into the future. Although I think as a historical hypothetical, I would say that eventually if the system basically does what it does, then eventually those regimes probably would have collapsed as well without being militarily conquered. But I think that's a very interesting perspective. What do you have to say about that?
Yeah, so I would add that what makes the Western neoliberal version or what have you, it's a softer version of the same phenomenon. So the more aggressive command economies of National Socialism in mid-century Germany, or communism, just like nationalization of existing assets, the way you sort of see this play out in like a traditional finance conversation is how banking in the United States versus banking in other countries operate. Like every other country other than the United States, it's way more obvious that the banks are completely a state fiction. It was created from essentially scratch. England might be an exemption to this, but basically it's much more obvious that they have political directives. Whereas in the United States, it grew out of kind of that northeastern banking syndicate, which was originally much more privatized. And even the Federal Reserve is almost like a revision of that same concept. The result is that the takeover of capital by management is much more insidious. So, when you nationalize an oil industry and fill it full of political officers, that's very over. It's almost like Yarvin's two-stroke versus four-stroke engine regime. Like when the PLA is the majority shareholder of Huawei, it's very obvious who is owning those things. The United States, we have much more layers of obfuscation, where the fact that you're generating publicly traded stock. Actually, let me back up a minute. So the synthesis of James Burnham and a friend of mine who I admire greatly in the financial world, Daniel Parisi, he actually has a book coming out soon called The Ownership Dividend. His previous book, Getting Back to Business, is very good on the topic of what was kind of a hint for all of this is in the 19th century and before the World Wars, stocks paid dividends, and owning those dividends was the main reason why people bought stock. Also, the communication of share price and the internal books and kind of like the nature, the companies themselves were much more opaque. So it's similar to the Austrian concept of price discovery, that, well, the only way you really can kind of measure whether a company is successful or not is by, can they pay a dividend? You don't really know anything about the internal financials or what their plans are, or whatever, but if they can make their dividend payments, that gives you a sense of like whether they're doing something right or wrong. However, since then, dividend paying stocks have almost entirely disappeared. Some still do, but people today do not buy stocks for the dividend. They buy it for capital appreciation. They're hoping that, if you're buying Microsoft stock, you're not buying it for the dividend. Generally, you in the generic sense are not buying it for the dividend. They're buying it for, well, I hope I buy it at 100 and sell it at 200 down the road. And the way that shareholder price or shareholder value can be synthesized is through stock buybacks and access to credit. And it's basically that's kind of the real point of control in a managerial regime, is as long as the stock price keeps going up, and especially the management are paid primarily in shares of stock, and equity growth is really how patronage is awarded. Nobody really gets rich by earning a good income anymore. It's all, you're issued equity, and then the price of that equity explodes. And when you go to sell, then you're able to capture that money that was created. But if you think back to, before modernity or the 20th century, if you're reading Pride and Prejudice and about how Mr. Darcy, why he's so wealthy, it's measured explicitly in how much his lands and, aristocratic holdings earn in a year. Everything was measured in terms of cash flow, not in asset price. And, even in my day job, my main practice of exit planning, this is very much the odd dichotomy as well. Outside of publicly traded markets, all valuations are done through discounted, or primarily at least estimated through discounted cash flow. It's only once you have these public markets of bid ask that suddenly it's decoupled from that. And then that's where central banking provides a cushion that, well, you're just inflating in order to boost the price, in order to get the people who have political access or receive patronage to get those shares to be able to cash in and be rewarded. So that's the handoff. And I'll add to the fact that stock price continues to go up is basically what neuters the owners from having any active interest in the company, and what allows the management to take over the day-to-day. So that, the C-suite or the managerial elites come in, the stock price goes up basically regardless of profitability, because inflation is going to replace that market discipline. And as a result, they're able to hire political cronies and allies within the system that make sure that they maintain those positions of power within the organization. Very much as in, say, a Soviet regime, you had the nomenclatura where they were using their positions in different government organizations in order to solidify their power and provide patronage and hire people who are going to support them and be loyal, rather than necessarily the most meritorious or skilled people to do that role. So very, very akin to the biological Leninism concept as well.
Yeah, that's very interesting. Very interesting indeed. I see a couple comments. Somebody, Johnson asks, who owns the Fed? Do we want to answer that question?
Right. So I will put it back to them that the more interesting question is looking at how open market operations and treasury bonds are sold, and who are the organizations that are obligated to make a market in that. There's actually an active question right now of whether capacity has been reached, that they can't manufacture enough demand in order to place the treasuries that are being sold. And that's another one of those tipping point questions of, have we reached the end of this stagnation that, if we can't keep upping the limit on the credit card, will we default on the ability to pay? Because all interest payments on outstanding debt is paid by issuing more debt. So as soon as that Ponzi scheme or musical chairs comes to a halt, it can't be sustained anymore.
Yeah, I think the most interesting thing to watch, and I'm a bit of a Fed watcher, admittedly,
Mm,
is seeing the Fed manipulate interest rates and then watching the market respond to those interest rates, and then seeing on my MSM feed, which if I want to know what the regime is doing at any given moment, I literally just look on Microsoft Edge and be like, okay, what articles are they putting out to the general public? What's the headline that they're running with today?
hmm
And when you see the headlines on economics, it's always, oh well, the Fed might not increase the interest rate anymore. We might not have to increase it. We can keep it stable, or it'll go down by 1/4%, or whatever the messaging today is.
hmm
But I think that at least this is what our good buddy Radlib and all of them on the Austrian side of things talk about is, okay, you have the Federal Reserve who's got the interest rates relatively high now, um, and the market's responding to that. And of course, the general knowledge is you've got, okay, high inflation. You need to increase the interest rate to keep the inflation tamped down, but at the same time, the market interest rate is now high, so now you're slowing down investment. And you have almost a witch's brew of, okay, well, if I move one lever, something is going to happen to another aspect of the lever, and it's going to make some, like, a different aspect of this triangle go out of balance. And so now it
hmm
appears to be a very careful balancing act. And I think it's going to be very interesting to see in the future of what the Fed actually does. Whether I think their most likely course is probably going to be just to hold steady and let it go.
So I'll add to the critics that people give the Fed way more credit or power than they really deserve, I think are right at the end of the day. Their role is kind of our version of Gosplan, is often exaggerated. And the main reason for this is what's called the euro banking system, or the euro dollar. Euro doesn't mean Europe, it just means outside the United States, basically. There are correspondence banks outside of the jurisdiction of the Federal Reserve, which also claim to own possession of many dollars. And then they interbank with others in order to, settle international trade and so forth. And it's beyond the purview of the Fed that they can operate completely without restriction for very much the same goal of, like, oh yeah, trust us, we've got billions of dollars in the bank. They may not have that. As long as they can meet the demand on the deposits, that fiction will continue. The why A big part of why I think interest rates went up so quickly and without as severe of a reaction as we experienced in 2018 when something very similar was attempted, is that it's been offset by the excessive supply of euro dollars outside the federal jurisdiction, which is able to keep that. That's kind of where the real cracks and faults happen, rather than inside the American domestic market. Another person who I admire within or analyst, I guess I should say, that I admire within the financial sphere, is a gentleman by the name of Mike Green. He does tend to be a kind of like a con ink or boomer con at the end of the day in terms of politics. I think that comes from a place of better the devil you know than the devil you don't. Like, okay, well, we know what the GAE is going to do. If that goes, it's a bigger unknown. But he has a hypothesis which I think is more correct than the standard one, of what really caused the 2008 crash was not housing. It was that Hurricane Katrina shut down or knocked out oil refining capacity in Louisiana. That created a shortage of available dollars in the euro banking system, which eventually caused a what's the word I'm looking for? Liquidity cascade, which then precipitated all of the subprime loan phenomenon, which is what traditionally gets the blame. The tell is that more in the bailout funds that were created in the wake of that, more money went to bailing out foreign banks through cross-purchase agreements than went to bailing out domestic banks for housing. But it's a very difficult political pitch to go to the American people and say, hey, we got to create all this money in order to bail out foreign banks, right? People are going to be like, well, why are we doing that? Why do we care? But if you make it about the American homeowner And, you kind of have some mea culpas of, well, maybe we shouldn't have given all these people who have a track record of never paying back their loans money to buy houses. But lesson learned, and hey, we all make mistakes. That's why pencils have erasers, and we're just going to patch this up and try to go back to normal. And eventually, they can kind of soothe over the grumbling with that. I think that's also a big part of, frankly, what I suspect is money laundering with a lot of the foreign aid and these proxy wars over the past several years is also about that. In order to shore up the supply of dollars outside the American jurisdiction, they're able to tighten the supply within the United States and not break anything. And that's how we've arrived at the position we're at, where interest rates were able to go up so fast, so high, and not reveal breakage in the same way that we were having that overnight repo rate collapse in like late 2019, which also seemed to coincide with the lockdowns that followed a month or two after. That's another way that I think credit was able to, the excuses were able to be made in order to provide that extra liquidity that markets needed to not collapse. But yeah, I think that's so. This is, again, I think, endemic of how the system is being managed. Is it the idea that we still have price discovery or profitable businesses, or that there's any kind of market discipline, has gone completely out the window. Zombie capital is rampant. I'm quoting this really off the top of my head, so I should go back and check. But it's something like 60% of companies are basically zombie capital at this point. Like, they make no profit other than that they receive loans, which is, I should look this up too. There's I'd have to think about this for a second. There's a concept in corporate finance of that there's no, and this is a doctrine that came about, I believe, in like the 50s or 60s, that there's no meaningful difference between receiving profit and getting loans. Like, from an accounting perspective, it's the same thing. This is also kind of the problem that Austrians try to identify, is that if you're running any kind of organizational budget, whether you get more money from loans or more money from profit is never really accounted for, other than that the loans theoretically you have to repay, and that the loans have counterparty risk in the way that profit doesn't. But that blurring is really kind of the bait and switch that occurs under the managerial regime.
Yeah, that's an interesting point. So in my dealings with some of the Austrian types, I have found that the distinction, and this is where you start getting into things like the Austrians call it preference schedules, and where you basically, it's a very basic, microecon exercise of like, okay, well, I have this much money, and if I'm basically, if you have this level of income, your purchasing power is therefore limited, and unconsciously or semi-consciously, you're deciding, okay, this is what I can afford. This is what I'm going to prioritize now, right? And one of the problems that the Austrians have with, especially, gigantic finance capital types who have almost unlimited income, is, well, why would somebody not decide to fund politics? Why would they not decide to, purchase out the Wall Street Journal like Jeff Bezos does, and simply say, okay, well, I've maxed out my income. I have so much money that money is basically no object at this point. It's so low on my preference schedule as the acquisition of more cash that I can afford to send it somewhere else. And I think that this is kind of attached to the problem that you just identified here, because really it's much less about where the cash is coming from than necessarily whether or not that cash is directly profit. So I think I think that those two issues are kind of connected, and I think the Austrians, because I think those two are connected, they have a bit of trouble identifying, like, okay, this person is a regime apparatchik, and even though they're technically a CEO of a major corporation, no, that doesn't mean that they're like pro-capitalism or that they're pro-market processes, purely speaking.
Right.
I think that this is where the trip up happens, and why you see Austrian types make that mistake.
Yeah, I agree. That's where the confusion is. So I was able to look it up quick. It's Mugliani and Miller theory, M&M theory. It's related to weighted average cost of capital if you're doing corporate accounting. But yeah, the unlimited money comes from the fact that they have unlimited lines of credit from a state or managerial backed bank, right? So that's where that public-private partnership layer occurs. Hey, as long as you implement DEI and ESG objectives, we're going to make sure you get that corporate loan so that you don't have to worry about doing unprofitable things. Oh, and by the way, you're going to have to add 10 other executive VPs who were formerly attached to the managerial state, and then vice versa. And, the really cliched examples would be going from the FDA to, Pfizer, or from a military general into Lockheed Martin.
Yeah, or a financial regulator into the markets, as everybody would recognize from things like The Big Short, right?
Right.
It's the exact same thing. But I think that there's also an interesting aspect to that as well, because the at least I think there's something unlooked at by or unknown by most people, is that those ESG objectives, they attach a lower interest rate for that capital that they're giving in exchange for service, basically. So not only are you receiving a lump sum of cash as a loan, your interest rate on that loan is lower than what it would have been if you had sought that out in normal market processes.
Right, which is another form of patronage. I mean, this also gets into, that there's kind of a close alliance between the Austrian school and the Virginia school, public choice theory, that intermeshing. Again, I think focusing on the divide between public and private confuses or muddles the issue more than it clarifies. Really, these are completely interwoven phenomenon, that if you're at the point that you have a publicly traded company, you're really part of the government apparatus or the administrative state. Instead of looking at it as, we have mostly capitalism with a little bit of socialism, and that's what makes a mixed economy. I think it's much more the other way around, that we primarily have a socialist or communized economy, and then the rare little bit of capitalism that we have is arguably private equity, small businesses, privately held capital. And conveniently, a big part of the lockdowns for 2 years from 2020 to 2022 was really to squeeze out a lot of those small privately owned businesses as well. Not to get too kind of in a, the navel gazing of conspiracy, but the more of, publicly traded companies as the ones who are overtly running or managing the economy. That's the trend line that we observe, right? There's far fewer small businesses and way more capital being given to these large publicly traded companies. And that's because, that's where the power is, and that's where the decisions are being made.
So would you describe the real economic driver and the economic engine of what remains of capitalism in the economy? Would you say that that's pretty much where most of the growth is, and most of the actual real economic activity and the real decisions in the economy, and everything else is kind of just an attachment to it? Would you agree with that statement?
Yeah, I mean, yes, but the size is off, right? So the Parasite has a greater mass than the host at this point, right? And that's why things have stagnated, is that the host is no longer able to generate enough life in order to sustain both the host and the Parasite, that the Parasite is just over consuming that. And that's why I think we've hit the 2008 great financial crisis was kind of one of the warning signs or breaking points. And a big part of why things have stagnated since is that there's just not enough genuine price discovery and profit in order to offset the parasitic draw from everything else in the system. I do think at the same time that exiting of those private funds from everything else, trying to cut out the cancer as much as possible, is probably what's going to create the closest thing to a life raft from this situation. Boomers, who have all of their retirement funds tied up in ERISA, which was created shortly on the heels of Nixon closing the gold window as a way to absorb the inflation that was being created by this system, getting people to delay the money hitting their payroll at that time for some future date. But now they're no longer contributing, they're withdrawing. And that's Mike Green uses the analogy of if you had a car and the brakes weren't working so well and you're driving uphill, because you're also fighting gravity, you don't notice it so much. But once you get over the top of that hill and you start going downhill and your brakes don't work so well, that's when you may not actually be able to stop and you're going to have a wreck. And between the demographic crisis of boomers retiring and withdrawing those funds rather than contributing, the adoption of indexing, which is kind of another example of we don't need all this price discovery information. We're just going to blindly buy into the market. There really is no such thing as passive investing. It's algorithmic investing. If you're using a so-called low-fee index fund, the algorithm is when you have money, buy, and when you need money, sell. And that's as far as it's thought out. And then you're just getting returns dependent on whatever the construction of the index is. So if you're one of the Fortune 500 companies that's in the S&P 500, your stock share price is going up because everybody's buying it just because it happens to be listed on that index. It has nothing to do at all with whether your company is profitable, not profitable. It's just purely on inertia. It's basically a trend effect. And the problem is if that trend reverses, you're in a heap of trouble. On top of that, younger generations, millennials and so on, who as young people lived through the 2008 GFC, are much more reluctant to invest in that market. In addition to the fact that basically since then there's never been a major downturn in order to buy in at a low. You see this with housing as well. Like the only time that the Schiller value of housing trended back to the inflation rate was briefly after 2008. So if you bought a home between 2009 and maybe 2013, you got a pretty fair market value for what that real estate was. But any other time, except going back to maybe the 90s, it's an overvalued asset. So on the one hand, younger people are priced out of being able to get into those positions. And then on the other hand, even if they have the money, there's a perception of, well, I'm buying in at a high. As soon as markets tank, I'm going to lose all that equity because I bought in when it was the most expensive it's ever been. The unwinding of the demographics of that phenomenon, and that boomers don't want to admit that they're old and that nobody lives forever, is I think the next crisis. That there's not enough liquidity in the market because everybody is synchronized to those same events. That the boomers who own all of that capital all own basically the same thing and are selling it at the same time, and there's nobody on the other side of that trade to be able to absorb what they need to sell. Despite this managerialist system, it is still predicated on the idea of state-backed actors, arguably, making a market, that somebody has to close that bid-ask spread. And we've seen examples where this hasn't been able to be done. I should double-check this, but I think if we look up AGG in early 2020, which is an intermediate bond ETF, it went untraded for like a week. Which it's a bond that should have a ton of market depth. Basically, that should never happen. It was resolved relatively quickly, but that's also kind of unheard of and never really discussed. So if you owned that and you needed to sell it in order to generate retirement income, in order to buy your groceries or to buy your medicine for that week or whatever, that market wasn't able to be made. And this is another, I think, hole in the Austrian theory of, well, markets are always going to clear. And of course, obviously absent coercion in terms of like price ceilings or price floors, but even due to the underpinnings of these markets not being organic or natural, but it's underpinned by sovereign bonds, treasuries, and then everything else is built up on that. There's a name for that too. It's like such and such as pyramid, where like theoretically gold is at the base of that and then bonds on top of that and so on. But if those markets can't clear because you have boomers who say, well, I'm not going to sell below what I think they're worth, and everybody else saying, well, I'm not going to pay more than pennies on the dollar for this, it just doesn't clear. And that's what you see when you have price ceilings or price floors is, the true minimum wage is zero because you can choose not to work, right? Or if bread is mandated to be below market cost, well, all that happens is stores just choose not to make bread at all. Like you get barren shelves. You see this with every time there's an emergency, and then if there's regulations on so-called price gouging, people need water. You can't charge $100 a case for bottles of water. We're going to make you sell it at what the prices were before the emergency. Well, clearly circumstances have changed and demand for water went through the roof. So it's just going to sell out and there's not going to be any water available, as opposed to water is available, albeit at a very high price, in order to discriminate, well, do you really need that water or you don't? And the people who really need it are going to find a way to pay that higher price. That is happening at a systemic demographic level with boomers as they age into retirement and need to spend down more of those investments with nobody on the other side of that trade to absorb it. How that plays out, I think, is going to be much more similar to what happened with mortgage-backed securities. There's arguments that people think that happened with special purpose vehicles during those 2 years of lockdowns for corporate bonds, that it seemed like a lot of suspicious trading was going on, that the government was able to, or the Fed was able to backdoor purchases, which is technically in violation of its charter. Very much like Bank of Japan has been doing since their economy went through the same process in, I believe, 1991. That's kind of what keeps this managerial system in a vicious circle, is that, the central banking system is what's backstopping or subsidizing this inefficient zombie capital and preventing a correction from ever occurring. And I think that's the part that Austrians kind of miss is, the reason why in Weimar Germany you actually had inflation in consumption goods is because you didn't have that asset bubble market in order to be able to absorb that inflation instead. This also kind of gets into Richard Werner's thing of anytime you have fiat currency, the money's either got to go into consumption, asset bubbles, or capital expansion. And whether in Japan or the system we're under, the asset bubbles are the easier thing to do. It's where the quick money is at. It's what people are incentivized to do. And as a result, that completely crowds out any real CapEx investment. CapEx investment also, it's risky. It may not work out. You may not get profit. You might lose money. So nobody does that. And that's where, that's part of what's nerfing the economy as well, is you don't have anybody investing in things that hope to make actual profit. Why should you, when you can invest in these accounting fictions that as a result are basically guaranteed to go up? But none of that is productive. None of that is actually making things, generating things, increasing efficiency. It's part of that parasite part of the equation that we were talking about.
So that's a very fascinating dialogue there. Or I should say monologue.
Sorry about that. Yeah, like rant. Yeah.
Yeah. No. That's why I wanted you on the channel. But yeah. So I think that there's one thing that the Austrians, I think what you were totally saying there makes a lot of sense. But I think that from a logical perspective, right, the Austrians are correct that really you kind of have a crypto-communist economy, right? I think that a lot of the Austrians are like whatever they were 40 years ago, 30 years ago. I think that many of them have now, if not that's their majoritarian position, where they're like, okay, all of this kind of sucks, right? I think that they understand that. I think that the problem with them is really they kind of just some of them might think, well, actually, you are in a capitalist economy, and we have to defend free trade or all.
Yeah,
of
that's
these,
what I was going to challenge.
Right?
Is do you see a lot of Austrians saying that publicly traded stock is communist? I mean, I think that's where we really need to be in order to meet the reality, and people are pretty shocked by that. I mean, coming from that background and knowing people who still think that way, they're real quick to be like, no, it's just when a group of people voluntarily choose to get
Well,
together and they're able to, issue stock certificates. But that's not how it plays out in practice. And when you look at the actual mechanisms of how it operates, especially, again, the origins in sovereign bonds, Liberty bond markets, that market making function is what all of that is built upon.
so let me steel man the Austrians for a second, right?
Yep.
So I guess and I'm not a super well versed Austrian theorist here, but I have read enough of Rothbard, and I have read Rothbard's plan to return to the gold standard, and I'm not certain how you could retain the stock exchange as it is currently formulated if you were to return to a more hard currency. I just don't see how that would be maintained whatsoever. So I mean, from the Austrian perspective, I think that that's probably correct, that you would, I mean, with gold inflows and outflows to a country, I don't think that there's really any way that you could maintain a stock exchange, and you certainly couldn't maintain it the way it is now.
Well, so that I would agree with. I think that that's my argument, is that a publicly traded securities market is a government socialization program. It's how genuine ownership by particular individuals is basically nerfed, and you get a dilution of ownership or responsibility among so many people, and then through so many layers of intermediaries in order to manage that widespread group. That basically, it's the iron law of oligarchy, or why democracy is always an impossibility. It's the democratization of capital, which is a bad thing. Which is then because you have multitudes of owners of stock. None of them are really in charge. They're not the ones making the command decisions. But your C-suite or managers who come in, they're the ones that actually have those positions of authority to make the decisions. But they're only able to do that by neutralizing the relevance of actual ownership of those companies. So again, and also they're there for a short time too, right? Managers who come in, they're not the founders. They're not part of the family of owners of it. They work in a job for 8 years, 10 years, 15 years, and then eventually they're ousted. And somebody else replaces them. So they're all temporary managers of this abstraction of an administrative organism that, that's my argument of that's how that managerial revolution is funded. That's how they were able to get that control is, these companies don't really represent any real ownership except through, it gets handed from manager to manager. And the price structure of that ownership is basically buoyed or kept alive through central banking always putting an underpinning of it pushes the stock price up, basically. That because of that asset bubble preference, the new money that gets created is most attracted to that stock to push that price up, and it takes all the performance pressure off of management. Because, hey, look, the share price is going up. You don't have to fire me. Clearly, I must be doing a good job. And that allows them to spend internally in the company on creating new projects, new departments, new works, new things that they're tackling. Those things don't necessarily have to be productive or meaningful, but it allows them to provide patronage the next layer down in order to hire people who are going to politically support them and keep them in that position.
Mm-hmm. Right. So the other thing I kind of wanted to talk about was that's related to this is in the early 20th century, this is something I read because Skeptic Waves put out Garrett Garrett's The Revolution Was, or The People's Pottage, I should say, which is a wonderful book. Everybody should go check out that particular work if you want to understand the very in detail and in-depth precise mechanisms of how this was achieved. And that's funny that you should mention in the early 20th century of, okay, we need the stock market to start generating the wealth, through artificial mechanisms, basically, but in order to fund the managerial revolution. But really, it's almost even earlier than that, right? Because I'm remembering what Garrett said about the Wilson administration, or maybe it was the early FDR administration. I think it was the Wilson one, because they were trying to fund the First World War. And essentially, right, you had I think it was the Fed, or a central banking mechanism, and they started with this general rule that you would back like a security deposit, or I forget exactly what it was now, but essentially they had a system where they were like, okay, we're backing this asset with 1 gold ounce and $1. And then eventually they would just say, okay, well, we're just getting rid of the dollar, and we'll just do it with just 1 gold ounce. And eventually then you just say, okay, well, we'll just back it with, $1, right?
Mm-hmm.
And so that's how and if you think about that, right, that's actually an inflationary expansion, or a monetary expansionary policy, right? What
Mm-hmm.
you're doing is you're saying, okay, I have this asset that is supposed to be backed by these classes of assets, but then you reduce the classes of assets necessary to back this particular security. And then what you're doing is you're saying, okay, now I'm going to totally change it from something that actually has real value, and I'm just doing it with the paper money, right?
Mm-hmm.
So it's just totally detached from anything that is of real value, at least from an Austrian economic perspective. So I thought that was very interesting, because I'm sure if you were to really look into it, and you'd find that was probably taking place at roughly the same time, because in order to get
Right.
the wealth generated to buy the stocks, you've got to expand the monetary policy.
Right, which is so, I think that's part of that same agenda that was unfolding under Woodrow Wilson's regime, or leading up to it in the progressive era. Is you saw a lot of criticism of, the so-called robber barons that you had, the Rockefellers and the Carnegies, that they were basically becoming, monarchs or kings of capital in a particular industry, and a combination of, the overeducated, the academics, and some populism as well, of, well, we don't want to be ruled by equity lords. This has to be a democratic participatory process. And the question was basically, how do you nationalize those assets without the obvious extreme of Soviet style nationalization? I mean, that's really, I think, what they were concerned with. It's a much softer form of, how do we have a transition of power that we're stripping it away from these particular individuals and their families, and transferring it over to, scientifically managed group of elites who are doing it so-called for everybody's benefit, and getting people used to owning these securities. And so very much like the way you go from a monarchy to a republic, or a monarchy to a democracy. That is almost identically the same process, except it was done to capital rather than political power. But the mechanism and concept and method is very similar. So you're the same way, hey, everybody should get a vote. Yeah, okay, well, we're going to dilute ownership through publicly traded stock in exactly the same way. And now ownership doesn't mean anything in the same way that voting doesn't mean anything. You've diluted it to the point that that's no longer where the locus of power is. And the locus is now going to be who organizes the political parties, who controls what the structure of holding events and holding elections and organizing is. They're now the power then shifts to the ones who are able to organize those political organs, right? As opposed to, a king being or an absolute monarch as owner of all of the, the territory and property. Now it shifts to management, right? That, like, the one layer down, the people who, the bureaucracy that files the paperwork. And I think that was very intentional. I mean, this starts to get into, what's that book again? This is gonna drive me nuts.
Well, while you're looking that up, I just like to mention, I have been to Carnegie's mansion on Lake Tahoe, and I've been to, like, Hurst Castle too, and that whole area actually of like, you have, I guess, more Central California and Northern California, I guess. It's a very beautiful place. You can see why these exceptionally wealthy titans of industry would create a mansion on a lake out in the middle of the Golden State,
like Xanadu, right? That
yeah.
yeah.
I mean, the water.
Tragedy and hope is what I was trying to think of as well. I mean, that is kind of what lays out the outline of how that process was formulated.
What was that work again? Say that again, please.
Tragedy and Hope by Carol Quigley.
Tragedy and Hope by Carol Quigley. Yeah. Interesting. Okay.
That basically, that's how academics then become the managers, the MBAs of these businesses, and that's how power is transferred through them. It's a very deliberate process, especially in the Wilsonian era, of why you have the founding of the Fed, the creation of income tax. Basically, all of those progressive era policies were designed to find soft ways of transferring power from the owners of these big industries into the hands of a politically aligned group who argued, well, this is necessary for the good of the people, right?
Right, and it hasn't gone unnoticed in our spheres, of course, that even the role of the CEO now, who's ostensibly in certain figures now, like a Carnegie or what's the big one that AA uses, the guy who runs the WWE or WEF or whatever, that wrestling foundation. I forget his name, but you all know the one I'm talking about. But that is what's that?
McMahon.
Yeah, McMahon.
Yep.
Yeah, Vince McMahon. Yeah, he's the CEO and manager, right? And the entrepreneur. So he's the founder and CEO. That's a totally different formulation than somebody who's been hired on as a CEO. Like even somebody like von Mises would say this, like the distinction between what is an employee and what is an actual entrepreneur. You can definitely make the argument that a CEO who has been hired on by the owner for a salary and who is paid out in share and stock price or stock assets, that's an employee. That's not somebody who is the actual entrepreneur of the company. So like he's an employee. He's a literal manager. Like he's not actually somebody who's taking risk and doing anything else. Like you mentioned before.
Yeah, this is like the criticism of like a constitutional republic, right? Oh, we're nobody's in charge because we're all in charge because we're all going to agree to this social contract, right? And the invention of the corporation is as faulty as that idea of the social contract. And the way that gets implemented is through, we're getting rid of the owners, we're getting rid of the kings, and we're replacing it with this theoretically neutral structure that then, anybody can own stock, right? Or everybody votes and participates, in that system. So it obfuscates the real locus of power because it's easier to rule when you have no responsibility, right? When you're able to have authority without accountability, which is the real goal of managerialism. I think Yarvin is correct about this, that if you had an obvious sovereign and when things go bad, you'd know who to blame. But with this system, if a company isn't performing well or creates a toxic spill or something, okay, well, the current person gets fired and you bring in another manager, but that manager thinks, acts, and talks just like the previous one. You're able to have kind of this cycle of fungible managers who are all going to operate the same way with the illusion of accountability. And same with politicians, right? Oh, we just got to, the politicians who are in charge now, they're so corrupt. We got to vote them out and put in different guys. Yeah, whoever you vote in is going to be exactly as corrupt as the people you're kicking out. The solution is not term limits or, voting harder. It's that the system is designed in order to evade accountability for the consequences of ill-used authority.
Yeah, as I like to say, new boss, same as the old boss.
Yep.
And all of these problems, or indeed all problems, really are structural. And so until you can address the root cause of the problem, which is to say the structural root of the problem, you're physically changing architecture in the system. It's not much is going to change. Like you can't vote your way out of that. That's not a structural change at all.
So I'm hoping, that the white pill in this is that we are reaching that point basically because of demographics with the boomers. Again, Nixon closed the gold window in 1971 or between 71 and 74. That's when,
71, yeah.
71. And then
71.
that's when, so ERISA, I believe, was passed in 74. That's when you got 401ks and IRAs. And that's when boomers were entering the workforce. And then especially, late 70s, early 80s, that's when the idea of everybody should open up an IRA or companies should be sponsoring a 401k. The pension system was getting raided due to the stagflation in the 1970s. And that left a bitter taste in everybody's mouth that all these promises of retirement income based on the sustainability of those corporate entities, right? So like Bethlehem Steel, you got your retirement because whoever was the owner of Bethlehem Steel was guaranteeing it based on their ability to provide for their people. And then circumstances are leveraged just in such a way that they are no longer able to meet that obligation. And now a government system of, oh, well, we're going to make people responsible for their own funding, and they're going to have to buy these assets which support the managers themselves, that you're creating buying pressure of everybody buying into these shares. That's that clever little switch there, right? The circulation of elites that, okay, it's no longer going to be big capital looking out for employees present and past. Now they've abandoned, it's like, without stretching this metaphor maybe too much, hey, it's a real pain to raise your kids and teach your kids, hand them off to public school, and then you don't have to worry about any of that, right? It's the, what's his name who wrote The Total State? The Juvenalian expansion of centralized power, right? Hey, doing the things that used to be the purview of private communities and, among private organizations gets crowded out by expanding managerial involvement in, hey, you don't have to do those things anymore. We'll take care of it. All you have to do is be loyal to our regime in order to make sure that you continue to get those benefits.
Yeah, it's interesting because that style of providing for employees past and present, that's a very, very much a more, I guess you might say, culturally Germanic way of doing things. It's a very, it's almost like the way a warlord behaves, right?
It's patronage, right? I mean, I think
exactly.
Bugbeef and them are right about we don't focus on patronage enough. And where does your ability to bestow boons on people who are loyal to you come from? And that's basically how management was able to use the banking system to provide, wealth and power that they didn't have otherwise, right?
They created their own patronage system, yeah.
Right. As opposed to if you were Henry Ford and you despised that financial system, he was doing it all himself and for the Ford family, right? He was big into the vertical integration. He wanted to own the rubber plantations that generated the rubber that made the tires that went on the Model T cars. He was trying to control that entire, the actual capex that provided that. And this is also, during the Japanese Empire until, taken over by the United States at the conclusion of the war. And then you got a bunch of new dealers in that completely reformulated their economy. But before then, that was also very much the system. Banking was more like investment banking in that the different keiretsu or zaibatsu, that based on their production capacity is what determined their own banking capacity. Sort of like the free banking era in the United States. And that created a lot of tension between, commodities producers that were based out of Chicago versus the New York City traditional banking financial elites. The different needs of the different regions used money in different ways, and that's why you had different banks that had different notes and so on. It's only so this comes back to what we were talking about too, about kind of like what is money, how is money defined, how does it emerge as a useful thing. I don't really subscribe to the gold bug theory of, well, it has to be a commodity money and it has to be this one specific commodity money. Again, because all money, as soon as you start to use it, becomes soft to a certain degree. As soon as you have income and expenses in operating a business, the time value of, when you're billed and when you pay those bills itself is going to soften money no matter how hard it is to begin with. Where whatever money gets used seems to start to carry some utility weight is from that organization of capital behind it. And that organizational structure, I think, is much closer to what defines money rather than necessarily a commodity money. And this kind of dovetails into both Mike Green and Curtis Yarvin came to the same conclusion. I'd love to know if they're like drawing on the same body of work for this, or what that would be, that a fiat currency is not it's obviously not a commodity money, and it's not even really a bond. Some people will argue, oh, well, it's a zero coupon perpetual bond because of the history of near money and treasuries. Really seems to be more like stock certificates or shares of stock, but in the regime itself. And whoever controls the ability to issue stock, as patronage, is really where the political power of that organization flows. So then that's the soft nationalization or soft appropriation mechanism, is instead of private industry doing that based on their productive capacity, you now have the government or the managerial state crowding out all of those other companies and doing it themselves.
So here's an interesting idea for you, because I've heard some interesting innovations that I guess more Austrian aligned people have thought about. And one of them, which I thought was really, really clever, was, what if you take a physical dollar bill, which is a printed paper currency, and you imbue this paper currency with an amount of a physical commodity, whether that's gold, whether that's silver, whatever. But so you're literally just saying, okay, I resolve the issue of paper money by infusing it with an actual dollar amount of precious metal. I think that might be a very interesting way that you could like structurally and I guess you're basically just building the physical gold into the system in a way that having a coin might not be so conducive to having, right?
So I mean, there's reasons why.
And I'm sorry to keep going, but like there's a reason why I harp on this, because in the 19th problem with gold outflows and trade, and the problem is whenever you have a massive outflow of gold, or you don't have enough currency in the market. This is one of the reasons why governments wanted to go to a silver currency and then eventually to a paper currency. Is okay. Well, 1 ounce of gold is actually very valuable, and so what happens if you don't have enough gold, or if gold as a single coin cannot pay for a smaller transactions on the extreme small side, then you end up with what token money, right? And so what I think that idea is so clever is because you're basically saying, okay, I can use gold now. It's small enough because we've imbued a little strip of gold into this piece of paper, and it's now worth exactly what it says on the front of it. And that's it. And we don't need to do any other manipulations with any other type of currency or talk about gold outflows or whatever. It's just literally it's in the money itself. So I thought that was pretty clever because it solves all those problems.
So how do I want to put this? I think we need to again come back to reevaluating kind of the definition of what is money and why does money emerge. And it emerges as a need for the efficient structure of capital for productivity, right? Money is meant to be representative of the productivity of organizing capital in a way that you have return on investment, that you have profit, that you're creating more resources than you're consuming. That's the core issue. I think the focus on commodity money, or focusing on money in that way, ignores the significance of that. And that's why you run into these other problems of, with gold, it's, how do you subdivide it? Or with, Bitcoin, you need access to the net. So even like Bitcoin is counterparty risk, right? You need access to other people to verify the transaction. You need the network running to do that. There's always going to be some other intermediary necessary in order to facilitate efficient transactions. But the purpose of the transaction is to get access to that productive capacity, right? That, hey, if I, run a business that provides value for people, they're able to, in some way, give me the information necessary that I can turn around to somebody else and have them provide me with, food, water, shelter, supplies to run my business, what have you. It's that that productive capital aspect of it that needs to be represented in money. And I don't think that no matter how sophisticated a form of commodity money is going to be, like, you're not going to tech your way out of this either. I think that's what it boils down to. This idea of like, oh, we just have to, it's almost that egalitarian managerial instinct of, oh, we just have to design money the right way and that will fix everything. Or we have to call the right thing money or agree on the right monetary standard and then everything is going to work. I think that's all rooted in that same faulty assumption. Where I think the focus needs to be is, how do entrepreneurs organize capital in a productive way in order to create that value in the first place, right? Like that's the origin. The money, the signifier, comes afterwards. You need the productive capacity first, and then how you quantify it, distribute it, whatever, is secondary. Beginning with the money puts the cart before the horse. So I think there, and I don't have all the answers to this. It's easier to ask questions than to answer them. But I think there's something to be said for looking at the history of free banking and kind of localism or regionalism, and then especially Japan before World War II, where a lot of the productive capacity used to be tied up in the imperial control, the mines for oil and metal and so on, and they were not very good at utilizing that. So they started giving government or imperial grants to entrepreneurial capitalists who then were very good at efficiently extracting those resources and using them in a productive way. And then those became the zaibatsu, who through vertical integration controlled a lot of productive capacity. And that also included how they financed their business. So sort of like Ford's idea of, I want to sell a car that my workers can afford. You have a system of, well, if my employees are going to save their money to make future purchases, they can save it in the bank of the company that they work in, which is where the working capital to employ them to be productive in this company originates from. You have a closer virtuous circle loop inside that productive capacity. Whereas when a government does that, for example, that's just another form of zombie capital. It's an unproductive enterprise that is in control for the sake of control, or because they have proficiency with violence, but they're not productive as an organization. That distinction. So instead of focusing on like public versus private or government versus corporate, I think it's like productive versus unproductive entities is a better approach to distinguishing success versus failure, right? Like what's an organizational structure that makes people's lives better over time, and which one is basically just wealth redistribution or a consumption scheme rather than a productive scheme. Does that make sense? I again, not to belabor the point, but yeah, I think focusing on like, well, we got to fix the money. And even though I'm in people want to use gold or Bitcoin or something other than government fiat currency, I don't blame you. I wish those projects well. But like with Bitcoin, okay, so like Bitcoin as an example, is anybody using Bitcoin yet to do their business accounting and operating a business in terms of, if they're a merchant shipping company and they're making purchases and then selling those goods later? Are they doing that in Bitcoin? Until that happens, it's an asset bubble. It's speculative. It's just a place that's absorbing inflation, as opposed to an organization of capital that by providing useful outcomes to people is actually, generating productivity. Does that make sense?
Yeah, it makes sense. I mean, I guess the whole gold issue really comes down to, like, that's just such a simple change, right? If you had
Mm.
the power to if you had control over a treasury and you just said, okay, tomorrow we're imbuing our currency with a very specific amount of gold or a specific amount of precious metal, and that's now you're directly taking the value of that commodity and you're placing it into the currency. And I don't know about you, but that just seems like very low hanging fruit and simple solutions. I mean, I'm all in favor of accomplishing low hanging fruit where you can get it done. So I
Yeah,
guess
I hear you.
that's
So it was Exter's pyramid that I was trying to think of before, which is very related to this as well. Is kind of like what is the base good that all other things come from? Um, I think it's instructive to look at like the history of agronomy. That before oil became the primary source of fuel for the Industrial Revolution, wheat production was really king. America and Russia were the two greatest wheat producers in the world. There's a great book, Oceans of Grain, that goes over like the history of this. Because the thing to remember too is that grain not only fed humans, it also fed the livestock, the beasts of burden that were the productive other pieces of farming and other labor that had to get done. So the ability to produce wheat was like the foundational unit of energy that became the base for all other productive capital structure. I think oil has replaced that to a large degree. Obviously, humans aren't going to eat oil, but for most other inputs, oil is the primary form of energy that's going into it. If we're looking at a commodity, I think that's where I understand the idea of like gold is like a store of value, but the productive use of capital is much more in like the doing of it than it. I mean, there is some validity to you can't eat gold, right? That you could be surrounded by a pile of gold, but if there's no food, like the diamond water paradox, right? It's the marginal utility of something is how all prices are discovered. So trying to define in terms of like a unit of gold misses that. And even just, speaking of low hanging fruit, right off the top, then it's a question of who's administering that system, and how do you know how are you verifying that system, and how do you know that's not rigged, and is that something that's going to be subject to gaming? I mean, that's the eternal problem with all of these systems, is that no matter how well you design the system, the people who administer the system are going to become the people who actually have the power, because they're going to decide enforcement, how it operates, when exemptions are made. Sovereign is he who decides the exception. That's always going to be where the real power is held. In light of that, that's why I keep coming back to the person who is making those administrative decisions needs to be the entrepreneur who understands how to organize capital in a productive way, as opposed to merely administering it. Like that's the key shift that I think gets lost in the shuffle, in this, modernity managerial system is, it went from owners who had to demonstrate productivity or else they went out of business, to now a system that evades that kind of market discipline.
very interesting. We're coming up on the hour and a half mark here. I don't know how much longer you're willing to go, but I think if we continue on for another hour and a half, or half of our audience probably will leave.
Yeah, that's fine. I mean, did you have? I think we've accomplished a lot so far. Did you have any other points that you wanted to follow up from there?
Yeah, I mean, sorry, I'm going to be super Austrian here and
That's
keep going
fine.
on the gold bug question.
This is good, because this is how we hash it out. This is, this is the crucible, right? So
Yeah,
go for it.
So I mean, the issue of any sort of money is that it's just simply it's a means of exchanging value that is not tied to a usable commodity. You can use literally anything as a form of currency. If you wanted to use wheat, you could. If you wanted to use like a set amount of like a barrel of oil, you could. I mean, that's probably partially how a lot of value gets traded these days, especially at the macro level. I'm sure, as you would assert. But really, when you're going to make payments, how do you exchange value when you have, because inevitably this comes down to the ancient problem of barter, right? You're going to get into the barter problem, and how do you trade one good for another if value is subjective, if you don't have an easily divisible thing to exchange and portable thing to exchange for certain goods, right? Because you can absolutely do a barter system where you trade sheep in exchange for grain, in exchange for timber, and it's absolutely possible on a practical level to do that. But the problem comes if with trying to do this at at the extreme micro level, because dividing a 2x4 is not something that you necessarily want to do. And then
how do you do it at scale? And I mean, and this is
how
also
do you do it quickly? How do you do it quickly? Because the amount of time that it takes to be like to haggle and to discuss about like, okay, well, like I don't have this asset now, but I can pay you this thing, this additional thing for this piece of lumber next
here's
week.
The thing with that too, though, is you had accounting, along with coinage, right? So the idea of like an IOU also existed. Even if you had a barter system, it would be, hey, I need to buy 4 cows off of you, but I'm, brewing some beer right now. And when the beer is done brewing, and we're going to factor into the exchange rate of the time value involved here too. When it's ready, I'm going to make good on delivery. And this is where you get like commodities futures markets, right? Which was the big tension between East Coast finance and Chicago, Mississippi River agricultural finance in America. Settling this kind of debt is, I guess I want to just point out that it's the difference between the sign and what is signified. Even in, hey, we need to agree on a currency in order to have a common unit of account in order to measure the relative value of disparate goods and, and so on. All of that proceeds after an entrepreneur has put capital to work to anticipate the needs of other people, right? That, hey, if you're arguing over, well, what currency do we use to settle the trade of, milk for t-shirts? You're still creating the milk and the t-shirts, anticipating that other people needed those things before you even got to the point of the money behind it. Actually, let me think this through. I'm kind of talking out of my ass right now.
Well, I mean, I think that what von Mises would assert is essentially there's a reason why precious metals as a commodity, especially in the ancient world or the pre-digital world, the pre-paper world, even, it was so commonly used. I think Mises is correct when he basically says, like, look, here's commodity money. It is real money, at least from pre-19th century or even pre-20th century norms, for very, very clear reasons. I don't think he's necessarily wrong about that. I think he's actually quite right, and the reasons why he lists are pretty
it's a low-hanging fruit, right? That it's what is it? Fungible, divisible, durable, and fixed in supply, right? Like what makes sound money is that it meets all these criteria, and especially if you're trading between people who speak different languages and have different cultures, but they both live in the same physical reality as everybody else. So it's a happy default of, hey, we're
I'm sorry, Sean. Your mic is acting up really bad right now. You were roboting a few minutes ago, but now you have a lot of static. So I don't know what the problem is. So maybe you could check your cable or check your mic.
Checking. Is it my system? Is that any better?
No, sorry.
Try this.
Well, while you're doing that, I have a couple comments I would like to address here. All right, so Bolero393 says, oh, I can hear myself through your mic now. Well, anyway, he says, is the other side of the coin correct as far as a board of directors, CEOs? Is the problem shareholders that don't risk much on individual stock? Well, maybe. I mean, there's also ways, even in the market, right? This is why mutual funds and ETFs exist. Is you combine things inside of the asset class and you reduce the risk for the individual investor, right? It's not like you're directly risking in stocks as much even anymore. So that's also part of the problem of the modern like stock exchanges, because you don't even have risk. You spread the risk out so much that you're not really risking anything at all. If that makes sense. At least that's what my assertion would be.
Yeah,
Sean
let me
looks like he's
test.
jumping in.
Okay, is my voice coming in okay, or is it still a problem?
It's still a problem.
I don't. I could try leaving and come back. Let me try that.
Yeah, let's do that. I'll let you join our guests for a few minutes here. All right, so let's see. Bolero393 also says Henry Ford is better than Elon Musk. Well, I don't know. I think Elon Musk is on a pathway, and he might find that Henry Ford was not so wrong about a few things. Let's see. Oh, and of course, Bolero393, I see your other addendum to that first comment there, as opposed to being willing to risk everything on a venture. Yeah, I mean, like I said before with the ETF and the mutual fund example, that seems to be what you're talking about here.
Can you hear? Yeah, am I doing better now?
Oh, you are just fine right now, loud and
Excellent.
clear.
All right, fantastic.
All right. So Bolero actually has an addendum to that comment. He says, as opposed to being willing to risk everything on a venture. So I think I was getting the point here of the ETFs and all of the CEOs and stuff. So go ahead and address it, Sean.
Yeah. So it's the principal agent problem. Yeah, there's no accountability with those intermediary structures. That's really the difference. And especially once you have something like stock buybacks where the earnings per share goes up, not because you're increasing earnings, but because you're decreasing the outstanding shares, it's very easy to manipulate the price of those shares. This is where I think Daniel Paris is much more accurate in focusing on cash flow as a measure of risk rather than volatility of asset price, because it's way easier to manipulate asset price as opposed to profit is supposed to be a measure of productivity. Like that's a more honest signal than just the share price, because So, and because it's diluted to that wider group, they don't know what's going on, right? Like they're not involved with, if you own Apple stock, you don't know any more than anybody else what their new laptop or their new piece of tech or whatever is going to be. You're just hoping that they're running a productive organization. But people now are looking for the share price to go up rather than to participate in the profitability of that. And part of that is the argument goes that, well, that company, instead of paying out dividends to the shareholders, can reinvest that money in the business in order to expand capacity or otherwise invest in the ability of the business itself. But realistically, what that means is that they're paying for patronage within the organization in order to keep their position of power. And part of that is because they're working with the same administrative state that has access to unlimited fiat currency, which is what that share price is denominated in order to keep that price high. So basically, shareholders are anesthetized by focusing on share price, because that's something that more or less can be rigged. And that actually, by definition, is what monetary policy is too, by the way. When the Fed tries to target a particular interest rate, they're manipulating the supply and demand of treasury bonds in order to achieve that interest rate. Corporations are just doing the same thing at a smaller scale.
Excellent. I don't see any other comments other than Minoan says he's got a few of the gold thingies from Utah. He says they're beautiful, but I doubt they'll catch on. The Utah Goldbacks. Artwork is outstanding. I mean, that's good to know. Getting these things to catch on is actually partially aesthetic, right? You have to make these things fashionable where
Mhm.
people will want to own them. I mean, I have some precious metals, of course, because I had extra, discretionary income, and I wanted to diversify my asset classes.
Mhm.
And of course, what are you going to put them in? Okay, well, put them in something that's safe and relatively hedge against inflation, because I knew it was going to start. I thought it was going to start getting pretty bad with inflation, so I was like, all right, well, buy in before it goes to the moon. But yeah, I don't think there's anything else I want to talk to you today about, Sean. So, do you have anything else to add for the stream?
Yeah, I think that's pretty much it. I mean, I'll add, just to kind of finish off that inflation conversation. In Weimar Germany, the people who owned shares of stock were the ones who got completely burned, but the people who had control of the actual assets of the businesses did extremely well. I think that's very telling, as far as, history doesn't repeat, but it rhymes. It's very telling of kind of how things are likely to look, I think, in the future, is these intermediated forms of ownership, I think, will struggle under any kind of real stress. Whereas the question is the actual productive capacity is where the focus should be. And I think that's the point of, kind of talking about like the utility of money is, are you able to get your needs met? Like that's really why you're saving for the future and trying to anticipate future need, is to be able to solve those future you problems.
Awesome. Well, thanks very much. So I understand that your book has not actually come out yet,
Yes.
but where can we find it when it does come out? What is the name of your book, and what information does it have that people might like?
So I've changed the title a few times now, so I'd have to look it up. So ultimately, when it's released, I'm going to release it through the Amazon Kindle publishing process, unless somebody has a better idea for that. I'm actually thinking about taking the chapters I've written so far and doling them out on a Substack in order to generate income, in order to afford more time for me to finish writing it. But between running my own business and then doing this, there's just never enough hours in the day. But I don't know, maybe somebody can add me to the Find My Friends list at some point and just kind of keep tabs on me, in the scene. And I'm sure I will make everybody aware of when it's available, once it's actually ready to be published.
Yeah, of course. I have no problem shilling on my channel, and I'm sure it'll go through the Telegram rounds and stuff.
Yep.
But anyway, so for me and my shilling, you all know who I am, and where to find me. I'm on the OGC Substack and their YouTube on Pony Express sometimes. And you can also go to my Substack, follow me on Twitter, etc., etc. I've taken up this sort of model of how I want to get reimbursed for my Substack, and how I get monetized. And the general pattern I found is, okay, I put my Substack behind the paywall, and then like a week later, however long it takes to edit the actual video for my articles, then I put them free public on my YouTube. So that seems to be kind of my way of getting monetized. I don't know. I feel like I'm a much better writer than I am a YouTube content creator. Although I think there's something to be said about the old days of actually doing edited videos. I think that was far, far, far superior to the live stream format that we have now. But anyway, yeah, you can also give me money through Substack, or you can also go to Buy Me a Coffee if you just want to throw me a couple bucks here or there. I really do appreciate it. This year's been pretty rough for me. So, yeah, thanks again, everybody. And that's pretty much it for the stream. So thank you again, Sean, for coming on.
Thanks for having me on. I appreciate the time. Thank you.
Mm-hmm. All right. Good night, everyone.